quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. What separates a professional trader from an amateur is not intelligence, not access to information, and not even strategy. It is structure. Specifically, it is the presence of a clearly defined, repeatable decision-making framework. Without that, every trade becomes a one-off event, every decision becomes reactive, and over time, that leads to inconsistency, emotional interference, and ultimately capital erosion. A personal trading framework is not just a set of rules, it is a system for thinking. It defines how you process information, how you interpret markets, how you allocate capital, and how you manage uncertainty. It is the architecture behind every decision you make. Most traders approach the market backwards. They start with strategies, they search for entry signals, they look for indicators that tell them when to buy and when to sell. But without a framework, those signals have no context. They are isolated pieces of information, disconnected from the broader environment. A framework solves this problem by providing context first and execution second. You begin with understanding the environment. What regime are we in? Is this a high volatility environment or a low volatility one? Is liquidity expanding or contracting? Are we in a risk on or risk off phase? These questions shape the landscape in which all trading decisions exist. Then you define your biases based on macro conditions, sentiment and positioning. Where do you expect capital to flow? Which assets are likely to outperform and which are likely to underperform? This is not about certainty, it is about probability alignment. Only after that do you consider execution, entry, stop placement, position sizing, and trade management all sit at the bottom of the framework, not at the top. This inversion of thinking is critical, because when execution is built on top of context, decisions become coherent. They are no longer random, they are expressions of a structured view. Without a framework, traders constantly change their approach. One week they are trend following, the next week they are mean reverting, then they switch to breakout strategies. This inconsistency is not due to lack of discipline, it is due to lack of structure. A framework anchors behavior. It ensures that even as market conditions change, your process remains consistent. You adapt within the framework, not outside of it. And this is where most traders fail to progress. They search for better signals instead of building better decision processes. They optimize entries instead of optimizing thinking. A professional trader does the opposite. They invest time in designing a framework that aligns with how markets actually function. A framework that integrates macro understanding, behavioral awareness, and risk control into a single unified process. Because in the long run, it is not the quality of individual trades that determines success. It is the quality of the system that produces those trades. To build a personal trading framework, you need to understand that there is no single correct model. There is no universal framework that works for everyone. What matters is alignment. Alignment between your framework and the way you process information, the time you can commit, the markets you trade, and the type of opportunities you are trying to capture. However, while frameworks are personal, their structure tends to follow consistent principles. At the highest level, a robust framework operates in layers. Each layer answers a different question, and together they form a complete decision-making process. The first layer is macro context. This is where you assess the broader environment. You are not trying to predict precise price movements. You are identifying conditions, growth trends, inflation dynamics, central bank behavior, liquidity cycles. These factors determine the underlying forces driving markets. If you ignore this layer, you are effectively trading in isolation. You are reacting to price without understanding what is driving it. That leads to fragile decision making. The second layer is market regime. This translates macro conditions into trading behavior. Are markets trending or ranging? Is volatility expanding or contracting? Are correlations stable or breaking down? This matters because different strategies perform differently across regimes. A trend-following approach works in trending markets but fails in range-bound environments. A mean reversion approach does the opposite. Without regime awareness, you will constantly be applying the wrong tool to the wrong environment. The third layer is relative value and opportunity selection. Here you identify where the best opportunities exist. Not all trades are equal. Some have stronger alignment with macro forces, better risk-reward profiles, and clearer narratives. This is where professional traders differentiate themselves. They do not trade everything. They focus on high-quality opportunities where multiple factors align. The fourth layer is execution. This includes entry timing, position sizing, stop placement, and trade management. Execution is important, but it sits at the bottom of the framework for a reason. It is the final step, not the starting point. Most traders overemphasize this layer. They spend hours optimizing entries while ignoring the layers above. As a result, even perfect execution cannot compensate for poor context. A well-structured framework ensures that execution is simply the expression of a well-formed view. It removes randomness, it creates consistency, and importantly, it allows you to evaluate performance properly. When you know exactly how a decision was made, you can assess whether it was correct based on process, not just outcome. Without this structure, improvement becomes impossible. You cannot refine what you cannot define. One of the most important distinctions in building a trading framework is the difference between top-down and bottom-up thinking. These are not just analytical approaches, they fundamentally shape how you see markets and how you make decisions. Top-down thinking starts with the big picture. You begin with macro conditions, then move down to asset classes, then to specific instruments, and finally to execution. It is a process of narrowing focus, filtering opportunities based on broader context. Bottom-up thinking does the opposite. It starts with individual charts, patterns, or signals and builds a view from there. It is more reactive. It focuses on what is happening now rather than why it is happening. Both approaches have merit, but the key is understanding their limitations. Bottom-up traders often struggle with context. They might identify a technically attractive setup, but fail to recognize that it is going against a dominant macro force. As a result, they experience frequent invalidation. Trades that look good on a chart fail because they are misaligned with the bigger picture. Top-down traders, on the other hand, sometimes struggle with timing. They may have a correct macro view, but enter too early or too late. They understand direction, but not execution precision. A professional framework integrates both approaches. It uses top-down analysis to define bias and bottom-up analysis to refine execution. This integration is critical because markets operate across multiple time frames and dimensions simultaneously. Macro forces drive direction, but microstructure determines how that direction unfolds. If you rely only on one perspective, your framework becomes incomplete. For example, consider a scenario where macro conditions favor a stronger currency. A top-down framework identifies this bias, but without bottom-up confirmation, you may enter during a short-term correction, exposing yourself to unnecessary drawdown. Conversely, a bottom-up signal might indicate a breakout, but without macro alignment, that breakout may lack follow-through, leading to false signals. The solution is not to choose one approach over the other. It is to define how they interact within your framework. You might decide that macro defines direction, while technicals define timing, or that certain macro conditions override technical signals entirely. The specific rules are less important than the clarity of the structure. What matters is that your framework has a defined hierarchy. You know which factors take precedence and under what conditions. Without this hierarchy, conflicting signals create confusion. You hesitate, you second guess, and your decision making deteriorates. A strong framework eliminates that ambiguity. It provides a clear pathway from analysis to action. Consistency is one of the most misunderstood concepts in trading. Many traders interpret consistency as doing the same thing repeatedly, regardless of conditions. In reality, consistency in trading is about applying a consistent process, not producing consistent actions. Markets are dynamic, conditions change, volatility shifts, correlations evolve. A rigid approach that ignores these changes is not consistent. It is inflexible, and inflexibility leads to failure. A professional trading framework must balance consistency with adaptability. Consistency comes from the process. You analyze markets in the same structured way. You assess the same variables. You follow the same decision pathway. This creates stability in your thinking. Adaptability comes from the output. Based on your analysis, your actions may differ. In one environment, you may favor trend-following strategies. In another, you may shift to mean reversion. The process remains the same, but the decisions adapt to the environment. This distinction is critical because it prevents two common errors. The first is overfitting. Traders who lack a structured process often adapt randomly. They change strategies based on recent outcomes, not underlying conditions. This creates inconsistency and erodes edge. The second is rigidity. Traders who misunderstand consistency refuse to adapt. They apply the same strategy in all environments, even when it is clearly ineffective. This leads to prolonged drawdowns. A well-designed framework avoids both extremes. It defines how adaptation occurs. It sets conditions under which certain strategies are valid and conditions under which they are not. For example, you might define that trend-following strategies are only applied in high-momentum environments, while mean reversion strategies are reserved for low volatility, range-bound conditions. The decision to switch is not emotional, it is rule-based. This structured adaptability is what allows professional traders to survive across different market regimes. It also improves psychological stability. When your actions are guided by a defined process, you are less likely to second-guess decisions. You understand why a trade was taken, and you accept the outcome as part of the process. Without this, every loss feels like a mistake, every win feels like validation, and over time, that emotional volatility leads to poor decision-making. Consistency in trading is not about outcomes, it is about behavior. It is about showing up every day and applying the same structured thinking regardless of recent performance. And that is what a personal trading framework ultimately provides. A stable foundation for decision making in an inherently unstable environment. Another critical component of a personal trading framework is defining your decision criteria. In other words, what conditions must be met before you commit capital. This is where many traders become vague. They rely on intuition, on feeling, or on loosely defined signals. That approach does not scale. It does not allow for consistent execution, and it makes performance evaluation almost impossible. Professional traders operate with clearly defined criteria, not because they eliminate uncertainty, but because they structure it. Your criteria should answer three key questions. First, why this trade? Second, why now? Third, why this size? Why this trade relates to opportunity selection? What makes this setup attractive? Is it aligned with macro forces? Does it offer favorable risk reward? Is there a clear narrative driving potential movement? Why now relates to timing. What has changed that makes this moment relevant? Has price reached a key level? Has new information entered the market? Has volatility shifted? Why this size relates to risk? How much capital are you allocating relative to the perceived opportunity and the associated uncertainty? This is where position sizing becomes an integral part of the framework. If you cannot answer these questions clearly, the trade is not defined. And if the trade is not defined, it should not be taken. This level of clarity does two things. First, it improves decision quality. You are forced to justify each trade based on structured reasoning. Second, it creates a feedback loop. After the trade, you can evaluate whether your criteria were valid. Over time, this allows you to refine your framework. You identify which conditions lead to positive outcomes and which do not. You adjust your criteria accordingly. Without defined criteria, this refinement process does not exist. You are left with random experiences rather than structured learning. It is important to understand that criteria are not static. They evolve as you gain experience and as market conditions change, but the process of defining them remains constant. This is another example of consistency within adaptability. The structure stays the same, but the content evolves. And this is what transforms trading from a reactive activity into a deliberate practice. You are no longer just participating in the market. You are systematically improving your ability to navigate it. A critical yet often overlooked aspect of a trading framework is time horizon. Not just how long you hold trades, but how your entire decision-making process aligns with time. Markets operate across multiple time frames simultaneously. Short-term noise, medium-term trends, and long-term macro forces all interact. If your framework does not clearly define its time horizon, you will experience constant conflict. For example, you may have a long-term bullish view based on macro conditions, but a short-term bearish signal based on technical structure. Without a defined hierarchy of time frames, this creates confusion. Do you buy, sell, or wait? A professional framework resolves this by assigning roles to different time horizons. You might define that macro analysis sets the long-term direction. Technical analysis refines medium-term positioning. Short-term price action determines entry timing. This creates alignment. Each time frame has a purpose. They do not compete, they complement each other. It also improves clarity during periods of volatility. When markets move sharply against your position in the short term, you can assess whether the long-term thesis remains intact. If it does, the move may represent noise rather than a signal to exit. Without this structure, traders often react to short-term fluctuations, abandoning valid long-term positions prematurely. Time horizon also influences strategy selection. Short-term trading requires different skills, different risk management, and different psychological resilience compared to longer-term positioning. If your framework does not align with your natural tendencies and available time, it will be difficult to execute consistently. For instance, if you cannot monitor markets throughout the day, a short-term trading framework will lead to missed opportunities and poor execution. Conversely, if you thrive on active decision-making, a long-term framework may feel too passive. Your framework must fit your reality, not an idealized version of trading, but your actual circumstances. This alignment is essential for sustainability because even the best framework is useless if it cannot be executed consistently. Time horizon is not just a technical detail, It is a foundational component of your entire approach. Feedback loops are what transform a trading framework from a static system into a dynamic, evolving process. Without feedback, your framework remains fixed. It does not improve, it does not adapt, and over time it becomes outdated. A feedback loop is a structured process of reviewing decisions, analyzing outcomes, and refining your approach. But this must be done correctly. Most traders focus on outcomes. They judge trades based on profit or loss. This is a mistake. Outcomes are influenced by randomness. A good decision can result in a loss. A poor decision can result in a profit. If you evaluate based on outcome alone, you reinforce the wrong behaviors. A professional feedback loop focuses on process. Did you follow your framework? Were your criteria met? Was the trade aligned with your defined structure? If the answer is yes, the trade is considered successful, regardless of outcome. If the answer is no, the trade is considered a failure, even if it was profitable. This distinction is essential because it aligns your learning with what actually matters. Over time, you also analyze patterns. Which types of trades perform well? Under what conditions does your framework produce the best results? Where are the weaknesses? This allows you to refine your framework systematically. You are not making random adjustments. You are making data-driven improvements. The key is consistency. Feedback must be regular, it must be structured, and it must be honest. This is where many traders struggle. It is uncomfortable to confront mistakes. It is easier to attribute losses to market conditions rather than flaws in your process. But without honest feedback, improvement is impossible. A well-designed framework includes feedback as an integral component. It defines how and when reviews are conducted. It ensures that learning is continuous, and this is what creates long-term progression. Not a single breakthrough, but a series of incremental improvements compounded over time. Simplicity is a principle that is often overlooked in trading frameworks. There is a tendency to equate complexity with sophistication. Traders add more indicators, more rules, more conditions, believing that this will improve performance. In reality, complexity often reduces effectiveness. A complex framework is difficult to execute. It creates hesitation. It increases the likelihood of errors, and it makes it harder to identify what is working and what is not. Simplicity, on the other hand, enhances clarity. It makes decision-making faster and more consistent. It allows you to focus on what truly matters. This does not mean oversimplification. It means removing unnecessary elements. It means ensuring that every component of your framework serves a clear purpose. For example, if you are using multiple indicators that provide similar information, you are not adding value, you are adding noise. A simple framework might focus on a few key variables: macro conditions, market regime, and price structure. That is sufficient to build a robust view. The goal is not to capture every detail, it is to capture the most important drivers. This principle also applies to rules. Too many rules create rigidity and confusion. Too few rules create ambiguity. The balance lies in having clear, concise guidelines that define behavior without overcomplicating it. Simplicity also improves adaptability. A simpler framework is easier to adjust as conditions change. A complex framework becomes fragile. Small changes can have unintended consequences. Professional traders understand this. Their frameworks are often elegant in their simplicity. They focus on core principles, executed consistently, and this is what creates robustness. Not complexity, but clarity. Ultimately, building a personal trading framework is about taking control of your decision-making process. It is about moving from reactive behavior to structured thinking. The market will always be uncertain. It will always present conflicting signals. It will always test your discipline. A framework does not eliminate these challenges. It provides a way to navigate them. It gives you a reference point, a set of principles that guide your actions, regardless of external conditions. This is what creates confidence, not confidence in outcomes, but confidence in process. You know that your decisions are grounded in a structured approach. You know that you are managing risk effectively. You know that you are operating with consistency, and that confidence is critical because trading is inherently uncomfortable. There is always uncertainty. There is always the possibility of loss. Without a framework, that discomfort leads to emotional decision making. With a framework, it becomes manageable. It is important to understand that your framework is not something you build once and then forget. It is a living system. It evolves as you gain experience, as markets change, and as your understanding deepens. But the core structure remains: the layers of analysis, the decision criteria, the integration of risk, the feedback loops. These elements form the foundation of professional trading. And once that foundation is in place, everything else becomes more effective. Strategies become more consistent. Execution becomes more disciplined. Performance becomes more stable, because you are no longer relying on isolated decisions. You are operating within a coherent system. And that is the transition from being a participant in the market to becoming a professional within it. Once a framework is established at a conceptual level, the next step is operationalizing it. This is where many traders fail. They understand the theory, they can articulate the layers, but when it comes to live markets, their execution deviates from the framework. Operationalization means translating abstract principles into concrete actions. It means defining exactly how your framework is applied in real time. This begins with pre-market preparation. Before any trading decisions are made, you need to assess the current environment through the lens of your framework. What is the macro backdrop? What regime are we in? Where is liquidity flowing? Which assets are showing relative strength or weakness? This process should be structured, not random observation, but a defined checklist. You are not scanning markets aimlessly. You are filtering information through your framework. Then comes scenario mapping. Based on your analysis, you define potential outcomes. Not predictions, but scenarios. If conditions remain stable, what is the most probable path? If certain variables change, how does that alter your view? This prepares you for uncertainty. Instead of reacting emotionally to market movements, you are executing within predefined expectations. During the trading session, your framework guides decision making. When a potential opportunity appears, you do not act immediately. You assess it against your criteria. Does it align with macro bias? Is it consistent with the current regime? Does it meet your risk parameters? If the answer is no, the trade is rejected. No debate, no hesitation. This is what creates discipline, not willpower, but structure. Post-trade, the framework continues to operate. You review the trade based on process adherence. You assess whether your decision-making was consistent with your framework. You identify areas for improvement. This full cycle integration, pre-market execution and review is what transforms a framework from theory into practice. Without this, frameworks remain intellectual exercises. With it, they become operational systems. A key element in making your framework actionable is the use of decision filters. These are mechanisms that reduce the number of trades you take by enforcing strict alignment with your framework. Most traders overtrade not because they lack discipline, but because they lack filters. Every movement looks like an opportunity. Every setup seems valid. This leads to excessive exposure and inconsistent performance. Decision filters solve this by narrowing focus. They define what not to trade as much as what to trade. For example, you might implement a macro alignment filter. If a trade does not align with your defined macro bias, it is automatically excluded. This removes a large portion of low probability trades. You might also implement a regime filter. Certain strategies are only valid in specific conditions. If the current environment does not support that strategy, it is not used. Another filter could be risk-reward. If a trade does not offer a minimum acceptable asymmetry, it is rejected. This ensures that even if your win rate is moderate, your overall expectancy remains positive. These filters act as a gatekeeping mechanism. They protect your capital by preventing unnecessary exposure. Importantly, filters must be objective. They must be defined in advance, not adjusted in the moment. If you start bending filters to justify trades, they lose their effectiveness. Over time, well-defined filters improve performance significantly, not by increasing the number of winning trades, but by eliminating poor quality trades. This is a subtle but powerful shift. Success in trading is not about doing more, it is about doing less, but doing it better. Another dimension of a professional trading framework is the integration of narrative and data. Markets are driven by both quantitative factors and qualitative narratives. Ignoring either creates an incomplete view. Data provides measurable inputs, economic indicators, price levels, volatility metrics, positioning data. These elements offer structure and objectivity. Narrative provides context. It explains why markets are behaving in a certain way. It reflects sentiment, expectations, and behavioral dynamics. A strong framework integrates both. It uses data to validate or challenge narrative, and narrative to interpret data. For instance, inflation data might indicate rising price pressures, but the market reaction depends on the narrative. Is inflation seen as transitory or persistent? Are central banks perceived as behind the curve or in control? These interpretations influence capital flows. If your framework relies solely on data, you risk missing the behavioral component of markets. If it relies solely on narrative, you risk subjectivity and bias. The balance lies in using data as the foundation and narrative as the lens through which that data is interpreted. This integration enhances decision making. It allows you to anticipate how markets might react, rather than just observing what has already happened. It also improves adaptability. As narratives shift, your framework can adjust without abandoning its structure. Understanding this interplay is critical for operating at a professional level. Because markets are not purely mechanical systems, they are driven by human behavior, expectations, and perception. An often underestimated component of a trading framework is energy management. This is not typically discussed in trading education, but it has a direct impact on decision quality. Trading is cognitively demanding. It requires sustained focus, rapid information processing, and emotional control. Without proper energy management, performance deteriorates. Your framework must account for this. This begins with defining when you are most effective. Some traders perform better during specific market sessions. Others require breaks to maintain focus. Identifying your optimal working periods is essential. It also involves limiting decision fatigue. The more decisions you make, the more your cognitive resources are depleted. This increases the likelihood of errors. A structured framework reduces unnecessary decisions. By filtering opportunities and defining criteria, you conserve mental energy for high-quality decisions. Rest and recovery are also part of the framework. Continuous exposure to markets without breaks leads to burnout. This impairs judgment and increases emotional reactivity. Professional traders treat energy as a resource just like capital. They allocate it carefully. This might involve setting limits on the number of trades per day, or defining specific times for analysis and execution, or incorporating regular breaks into the trading routine. Ignoring this aspect leads to inconsistency. Even the best framework cannot compensate for cognitive fatigue. By integrating energy management into your framework, you enhance sustainability. You ensure that your decision making remains sharp over the long term. Another critical layer is defining your edge within the framework. An edge is not a single signal or strategy. It is the combination of factors that give you a probabilistic advantage. Your framework should clearly articulate where that advantage comes from. Is it macro insight? Do you have a deeper understanding of economic dynamics that allows you to anticipate market movements? Is it behavioral? Are you able to identify and exploit common market biases? Is it structural? Do you understand liquidity dynamics or positioning in a way that others do not? Defining your edge is essential because it shapes your entire approach. It determines which opportunities you focus on and which you ignore. Without a clear edge, your framework becomes generic. You are competing in areas where you have no advantage. A professional trader specializes. They focus on specific conditions, specific markets, or specific types of trades where their edge is strongest. This specialization improves efficiency. It allows for deeper understanding and more precise execution. It also enhances confidence. When you know where your edge lies, you are more selective. You wait for conditions that align with your strengths. Over time, this leads to more consistent performance. Your edge is not static. It evolves as you gain experience and as markets change, but your framework must always be centered around it, because without an edge, even the most structured framework cannot produce positive expectancy. A robust framework also defines how you handle uncertainty and ambiguity. Markets rarely present clear, unambiguous signals. More often, you are dealing with incomplete information and conflicting data. Your framework must provide guidance in these situations. One approach is to define confidence levels. Not all trades are equal. Some have stronger alignment across your framework, while others are less clear. You might categorize opportunities based on conviction. High conviction trades meet multiple criteria and justify larger position sizes. Lower conviction trades are smaller or avoided entirely. This introduces nuance into your framework. It recognizes that certainty is not binary. Another approach is defining conditions for inaction. Knowing when not to trade is as important as knowing when to trade. If the market is unclear, if signals are conflicting, or if conditions do not meet your criteria, the correct decision is often to do nothing. This is difficult for many traders. There is a tendency to feel that inactivity is unproductive. In reality, it is a form of discipline. A well-defined framework makes inaction an active decision. It removes the pressure to constantly engage with the market. This improves overall performance by reducing unnecessary trades and preserving capital. Handling uncertainty effectively is a hallmark of professional trading. It is not about eliminating ambiguity, but about managing it within a structured process. Technology and tools also play a role in your framework, but they must be used correctly. Tools are enablers, not decision makers. Charts, indicators, data platforms, execution systems. These are all components that support your framework, but they should not define it. A common mistake is becoming overly reliant on tools. Traders search for the perfect indicator or the best platform, believing that this will improve performance. In reality, tools only enhance what is already present. If your framework is weak, better tools will not fix it. Your framework should dictate how tools are used. For example, you might use charts to identify key levels or patterns, but those insights are interpreted within your broader framework. Data platforms might provide macro information, but you filter that information based on your defined criteria. Execution tools help implement trades efficiently, but they do not determine whether a trade should be taken. This hierarchy is important. It ensures that your decision making remains grounded in your framework, not driven by external inputs. It also prevents overcomplication. With so many tools available, it is easy to create a cluttered environment. This increases noise and reduces clarity. A professional setup is often simple, a few well-chosen tools used consistently within a structured framework. This enhances efficiency and reduces cognitive load. Another aspect to consider is how your framework interacts with your psychology. Trading is not just a technical activity. It is deeply influenced by emotional and behavioral factors. Your framework should be designed to mitigate psychological biases. For example, loss aversion can lead to holding losing trades for too long. A framework with predefined stops and risk limits prevents this behavior. Overconfidence can lead to excessive risk taking. Position sizing rules and risk caps help control this. Recency bias can cause you to overreact to recent outcomes. A structured process ensures that decisions are based on defined criteria, not recent performance. In this way, your framework acts as a buffer between your emotions and your actions. It does not eliminate emotions. That is not possible, but it prevents them from dictating decisions. This is critical for consistency, because emotional decision-making is inherently unstable. A well-designed framework creates a layer of objectivity. It ensures that your actions are aligned with your process, not your feelings. Over time, this also improves psychological resilience. As you see the benefits of structured decision-making, confidence in the framework increases. This reduces emotional volatility and enhances overall performance. Your framework must also define how you scale. Scaling is not just about increasing position size, it is about expanding your activity in a controlled and sustainable way. As your capital grows, as your experience increases, and as your edge becomes more refined, your framework should allow for scaling. This might involve increasing position sizes, but only within defined risk parameters. It might involve trading additional markets, but only if they align with your framework and do not dilute your focus. It might involve increasing frequency, but only if your decision quality remains high. Scaling without structure is dangerous. It amplifies both gains and losses. Without a framework, it often leads to overexposure and significant drawdowns. A professional framework defines the conditions under which scaling is appropriate. It ensures that growth is gradual and controlled. This is essential for long-term sustainability. Finally, it is important to recognize that building a personal trading framework is an iterative process. It is not something that is completed once and then remains unchanged. Your initial framework will be imperfect. That is expected. The goal is not perfection, but progression. As you gain experience, you will identify strengths and weaknesses. You will refine your criteria. You will adjust your filters. You will improve your understanding of markets. This continuous improvement is what leads to mastery. However, iteration must be structured. Changes should be based on evidence, not impulse. You should understand why an adjustment is being made and what impact it is expected to have. Random changes create instability. Structured adjustments enhance performance. Over time, your framework becomes more refined, more aligned with your strengths, and more effective. This is the journey of a professional trader. Not chasing the perfect strategy, but continuously improving the system that produces decisions. And that system, your personal trading framework, is the foundation of everything you do in the market. At this stage, the framework is no longer just a structure for making decisions. It becomes a mechanism for eliminating inconsistency. And this is where the real transformation begins, because inconsistency is the single biggest obstacle to long-term performance in trading. Inconsistency does not come from lack of knowledge, it comes from variability in behavior. One day you follow your process, the next day you override it. One trade is structured, the next is impulsive. Over time, this creates a fragmented performance profile. A properly built framework removes that variability. It standardizes how decisions are made, not by restricting flexibility, but by defining it. Every trade is processed through the same sequence: context, regime, opportunity, risk, execution. This sequence does not change. What changes is the output, based on the information within each layer. This is what creates behavioral consistency. And behavioral consistency is what allows statistical consistency to emerge over time. If your behavior is random, your results will be random. If your behavior is structured, your results become measurable. This is a critical shift, because once results are measurable, they can be improved. Without a framework, you are relying on intuition. And intuition in trading is unreliable unless it is built on years of structured experience. The framework accelerates that process. It creates a controlled environment in which experience compounds effectively. This is why professional traders prioritize process over outcome, because process is controllable, outcome is not. And once you fully internalize this, your relationship with trading changes. You stop chasing results and you start refining behavior. Another important element is the concept of trade independence within your framework. Each trade must be treated as a separate event within a larger distribution. This sounds simple, but in practice it is one of the hardest things to maintain. Traders naturally link outcomes. A losing trade affects the next decision. A winning streak increases confidence and risk-taking. This creates emotional carryover. A structured framework breaks that link. Each trade is evaluated based on its own criteria. It is taken because it meets the defined conditions, not because of what happened previously. This ensures that decision quality remains stable. It also protects you from two dangerous behaviors: revenge trading and overconfidence. Revenge trading occurs when a trader tries to recover losses quickly by taking additional trades outside of their framework. Overconfidence occurs when a trader increases risk after a series of wins, believing they have superior insight. Both behaviors are driven by outcome dependence. A professional framework eliminates this by enforcing process independence. You do not adjust your behavior based on recent results. You adjust it based on structured feedback over a meaningful sample size. This aligns your actions with probability, not emotion. Over time, this creates a stable performance profile. Your results reflect your edge, not your emotional state. Your framework must also define how you manage information flow. In modern markets, there is an overwhelming amount of data available: news, analysis, social media, economic releases, price movements. Without structure, this leads to overload. Information overload reduces clarity. It creates conflicting signals. It increases hesitation. A professional framework filters information. It defines what is relevant and what is noise. For example, if your framework is driven by macro and medium-term positioning, short-term news noise may be irrelevant. If your framework is short-term, then real-time data becomes more important. The key is alignment. Information should be consumed based on its relevance to your framework. This requires discipline. It means ignoring large amounts of data that do not add value. It also requires consistency. The same types of information should be analyzed in the same way at the same stage of your process. This creates efficiency. It reduces cognitive load. It improves decision speed. Without this, traders become reactive. They chase headlines. They adjust views constantly. This leads to instability. A structured information process ensures that your decisions are based on filtered, relevant inputs. This is essential for maintaining clarity in a complex environment. Another layer is defining your tolerance for drawdowns within the framework. Drawdowns are inevitable. They are part of the probabilistic nature of trading. However, how you respond to them is critical. Your framework should define acceptable drawdown levels, both at the trade level and at the portfolio level. At the trade level, this is managed through stop placement and position sizing. At the portfolio level, it involves overall exposure and risk limits. But beyond the numbers, there is a behavioral component. When drawdowns occur, there is a natural tendency to change behavior, to reduce risk excessively, to abandon the framework, or to take impulsive trades to recover losses. A professional framework anticipates this. It defines how behavior should remain consistent during drawdowns. For example, you might reduce position size after a certain level of drawdown, but maintain the same decision criteria, or you might temporarily reduce activity while maintaining analysis. The key is that these adjustments are predefined. They are not reactive. This ensures that drawdowns do not lead to destructive behavior. It also reinforces discipline. You understand that drawdowns are part of the distribution, not a signal that the framework is broken. This perspective is essential for long-term survival. A well-developed framework also incorporates the concept of opportunity cost. Capital is finite, time is finite, attention is finite. Every trade you take consumes these resources. This means that taking a low-quality trade is not neutral. It has a cost. It prevents you from allocating resources to higher quality opportunities. Professional traders are highly selective. They understand that not all opportunities are equal. Your framework should reflect this. It should prioritize high conviction trades. It should limit exposure to marginal setups. This improves overall efficiency. It increases the average quality of trades. It enhances risk-adjusted returns. It also reduces stress. Fewer trades, taken with higher conviction, are easier to manage than constant activity. Opportunity cost is often overlooked because it is not immediately visible, but over time it has a significant impact on performance. By incorporating it into your framework, you ensure that your resources are allocated effectively. Another dimension is the integration of portfolio thinking into your framework. Even if you are trading individual positions, your exposure exists within a broader context. Trades are not independent from a risk perspective. They can be correlated. They can be influenced by the same macro factors. For example, multiple trades might be exposed to the same currency, the same asset class, or the same macro theme. If your framework does not account for this, you may be unintentionally concentrating risk. A professional framework tracks exposure across positions. It assesses correlation. It ensures that overall risk remains within defined limits. This might involve reducing position sizes when exposure is concentrated, or avoiding trades that increase correlation unnecessarily. Portfolio thinking enhances risk control. It ensures that losses are not amplified by hidden correlations. It also improves capital allocation. You prioritize trades that add diversification and balance to your portfolio. This is a more advanced layer of thinking, but it is essential for scaling and long-term consistency. Execution discipline is where the framework meets reality. It is one thing to define a process, it is another to follow it under pressure. Markets move quickly, opportunities appear and disappear, emotions are triggered. Your framework must be robust enough to operate in this environment. This requires clarity. Execution rules should be simple and unambiguous. There should be no room for interpretation in the moment. For example, entry criteria should be clearly defined. Stop levels should be predetermined. Position sizes should be calculated in advance. This reduces decision making during execution. It allows you to act decisively. It also reduces emotional interference. When rules are clear, there is less room for doubt. Execution discipline is not about perfection, it is about consistency, following the framework as closely as possible. Over time, this consistency leads to more stable performance. Without it, even the best framework fails because it is not applied correctly. Your framework should also define how you handle missed opportunities. This is an area where many traders struggle. Missing a trade can create frustration. There is a tendency to chase the market, entering late or at unfavorable levels. This behavior is driven by fear of missing out. A professional framework addresses this. It defines that missed trades are part of the process. If a trade is not taken according to the framework, it is not a valid trade, regardless of how it performs afterwards. This perspective removes emotional pressure. It reinforces discipline. It also protects capital. Chasing trades often leads to poor entries and increased risk. Your framework should include rules for re-entry if applicable. Under what conditions can a missed opportunity be revisited? If those conditions are not met, the opportunity is ignored. This creates clarity. It prevents reactive behavior. Over time, this discipline improves overall performance by reducing low-quality trades. As your framework matures, it becomes more intuitive, not in the sense of abandoning structure, but in the sense that the structure becomes internalized. You no longer consciously think through every step. The process becomes automatic. This is similar to any skill. At first, it requires deliberate effort. Over time, it becomes second nature. However, this does not mean abandoning the framework. It means that the framework is embedded in your thinking. This is where experience and structure converge. Intuition, in this context, is not guesswork. It is pattern recognition built on a structured foundation. It allows for faster decision making without sacrificing quality. But this only develops if the framework is applied consistently over time. Without that consistency, intuition becomes unreliable. The goal is not to replace the framework with intuition, but to integrate them. This creates a higher level of proficiency. Decisions are both structured and efficient. Ultimately, a personal trading framework is the foundation of professional trading. It is what transforms trading from a reactive activity into a structured discipline. It defines how you think, how you act, and how you improve. It integrates analysis, execution, risk, and feedback into a single coherent system. And most importantly, it creates consistency. Consistency in behavior leads to consistency in performance. Over time, this allows your edge to manifest. Without a framework, trading remains fragmented, decisions are inconsistent, learning is random. With a framework, trading becomes a process, a repeatable, measurable, and improvable process. This is what enables long-term survival and growth, because in the end, success in trading is not about individual trades. It is about the system that produces them, and that system is your framework.